Hey everyone, my name is Jesse and welcome back to Stone Cold Investors. Today we're going to be checking out Meta and getting another subpar stock valuation on it from a completely unqualified stranger on YouTube, which is also me. So let's get into it. All right, so first let's get into the chart, and let's see, on the 1 year basis we can see that we kind of topped up around 380. Let's see, on about 9.1. It's just been in a solid downtrend, gap down, and we're sitting at about 170 right now. We got as low as 154, 155, something like that. If we go through the 2 year and then the 5 year. Let's go to the 5 year. So the 5 year, interestingly, this was the COVID crash. Got down to about 140 and then ripped up to 380 and then almost got back down into that 140 area. We haven't gone there yet, but it looks like we could potentially. We'll see what Meta reports on, is it Tuesday? We'll see what they report on Tuesday. If they show continued weakness in the advertising space, we may get a little bit of a gap down further, and we might get into that 130 to 140 area potentially, which would be retesting some of these previous lows over here. So we'll see what happens on Tuesday. I think it's Tuesday, sometime this week. I think it's the 27th, so that would be Thursday. I don't know, sometime. So when they report, we'll see what happens. But yeah, that's pretty much it from just the price action. So let's jump over to the, we'll go over the balance sheet, and then we'll go over some revenue numbers, income numbers, and things like that. All right, so I hopped over to Ticker Terminal, and it's one of the tools I use to look at company fundamentals and historical data. So if we go over to Ticker Terminal, I graphed this out already. Currently we've got total cash and short-term investments, 49 billion or 48 billion. Total liabilities, 41 billion. Total current liabilities, 21.1 billion. So we can see that, throughout time, let's go back to like 2012, sure. Throughout time, they've kept a solid short-term balance compared to their short-term liabilities or even their total liabilities. Actually, right now is probably one of the times where their short-term cash and investments is closer to their total current or total liabilities. But we're talking about total liabilities, which includes long-term and everything. So from that position, from a cash position, they look pretty dang solid. I think last quarter they cash flowed, I want to say it was like 5 or 6 billion in free cash flow. We can check that out here. Now we'll skip that. We'll have it in the other sheet, but we can see that total assets is about 1.6 or 164 billion. So total assets still pretty high, but I like to usually just look at cash and short-term or total current assets. But from an asset to liability standpoint, they are looking pretty solid. So let's jump over to the valuation sheets. All right, so got my numbers plugged in here, and let me make sure everything kind of looks right. Yeah, it looks pretty good. So here we can see just a visual of their, I should have revenue in here, I think. Let's change that real quick. Dun. Data range, I want to add series, I want to add revenue. There we go. Boom. So we'll add that. So going back to 2012, we can see they've had really consistent growth, basically on top line and bottom line numbers, almost like very, very consistent. It's been a really good performer. Let's remove total revenue. So we can kind of see gross profit, operating income, EBIT, net income, and free cash flow. we see all these metrics just kind of slowly chug their way up. If we look at their margins, we can see gross margins are usually around like 80%, 90%. So their margins are just pretty ridiculous. Operating margins and net margins have stayed fairly consistent. They've fluctuated a little bit here and there, but they're still at, about 30% margins of their bottom line compared to their total revenue. So margins are looking really good. ROA, ROC, ROE, return on capital, yeah, looking also very good. 30%. Shares outstanding. We have dilution, and they peaked their dilution in 2017, and they've been doing fairly steady share buybacks ever since then. They currently have a share buyback program in place, and it looks like they're going to continue doing share buybacks. Kind of get to their growth metrics. And early on in companies, like, this chart's going to be pretty messed up because your growth is going to be fairly large on a percentage basis, and it's only when you meet a certain point of critical mass that percentage basis is going to moderate, right? It's way easier to grow 1 billion to 2 billion than it is 100 billion to 200 billion. So we can see currently they're sitting at, their growth is right around, free cash flow growth was 65%. 42, 35. Now we had, I need to double check those numbers. That seems really high, but, and then short-term quick ratio and operating cash flow to current liabilities. It's looking really good. So they've got basically 2x, 2.2x the operating cash flow to their current liabilities, which is awesome, really good. These growth numbers, I want to say, might be a little bit messed up. I might need to recalculate the way that I'm looking at these growth numbers. So bottom line growth, about 32%, and obviously go and validate and verify all these numbers for yourself. But on the historical 5-year basis, we've kind of got the risk-free rate, or the 10-year treasury, sitting about 1.99 average over the last 5 years. Dilution over the last 5 years for Meta, Facebook, whatever. They've actually been buying back stock, and they've been buying back about almost 0.5% per year. So I like to look at that as a form of basically just a dividend back to me, the investor, where I'm getting to own more and more of the company through them just taking their massive amounts of cash and buying back stock. As long as the stock is at a good price point, good valuation for them to buy it back, I'm happy. If the stock is really like super high, I'd almost just rather have them diluting to raise cash for R&D growth. Bottom line growth 32%, EBIT yield spread, net yield spread, free cash flow yield spread, right between 2.7 and 1.8 between those two. Average yield spread, and this is the spread between the risk-free rate and what the stock is currently trading at on a bottom line basis, as far as the free cash flow yield, net yield, and EBIT yield compared to the risk-free rate yield. So if it's a spread of 2.7 and the average 10-year treasury risk-free rate was 1.99, we would say that the on average, the equity was yielding about 4.7 compared to the risk-free rate on an EBT basis. So usually for my investments, I'm doing a base target compounded annual growth rate of 15, margin safety of 5, so my target rate's really 20%, 5% for that margin of safety. We go to the valuation section right here. You can kind of see that my estimates across these different probabilities, and these probabilities are typically going to be, let's see, this is kind of how I like to structure it. Let's go here on a probability basis. And I might, I'm going to do it. I'm going to take this so we can calculate the pegs on Meta as well. There we go. So, what we can see is I'm trying to do like about 5% probability for very bearish. Bearish is going to be about 25% probability. Base case is where I think most likely that's what's going to happen. So 55%, and then bullish 10%, very bullish 5%. So the majority of what I really believe is going to happen is going to lie usually between this bearish and base case. So if we go to the PEG ratios, we can see the current PE is 12.81. On a very bearish PEG, I have actually negative growth, so the PEG's negative. Bearish, it's 2.56. Base case, it's 1.28. Bullish PEG, it's 1.07. Very bullish, it's 0.085. And that's just current PE divided by future growth percentage, which I believe these are very realistic bottom line growth percentages. We're not talking about top line, we're talking about bottom line. So all of these, don't think revenue growth, think revenue growth, but also margin expansion, increased efficiencies in order to grow your bottom line net income, EBIT, and free cash flow. So very bearish. I have the risk-free rate going from 5% to 2%, from very bearish to very bullish. The future dilution estimate from very bearish is 1% to very bullish -3, right? So 1% of dilution per year versus 3% per year in buybacks. Bottom line growth, very bearish 5%, very bullish 15%. So, and I think very bullish is actually pretty achievable. I would potentially redo these probabilities, but and then yield spreads. So I kind of took the average yield spread, and put that for the base case, and then I essentially incremented it by about 0.7 or so in each direction. So we've got very bearish for EBIT, net, and free cash flow yield spread. Very bearish is 4.3, 3.08, and 2.94, and then going all the way to very bullish, we have 2.25, 1.8, 1.5. So, and these are just my assumptions. I think they obviously had some regression with the changes in with the App Store, iOS, how Apple allows advertisings and data scraping and stuff like that. But long term, I think it's going to be one of those that, in my opinion, has a good chance of regressing, but being able to cut back in certain areas to keep their bottom line strong, but then also grow bottom line going forward long term. So those are my estimates. If we look at the, basically, if we look at the, given my estimates from what I believe is going to happen, and every investor is going to be different. Everybody is going to have different opinions of what will or will not happen. So obviously do your own due diligence research, and you should be coming up with your own numbers. But based off of my numbers, we can see that the price right now is in a buy through the base case, the bullish case, and the very bullish case. Even on the bearish case of 5% growth, if we hit those yields with 5% growth, it's still about an 8.79% compounded annual growth rate. The only one that we have negative is the very bearish scenario, and that assumes that we're going to actually have regression over the next 5 years with an average decline in bottom line metrics of 5% every year. So, and we can see right now, if we actually go to the, here we go, the yields on market cap, we can see that yields on market cap right now, EBIT is 9.35%, free cash flow is 8.33, and net is 7.81. So we can see kind of like we had this, like, it just kind of kept on getting more and more and more discounted compared to the risk-free rate, especially in this 21 area. And that 2021 area is when we saw that fairly heavy, 2021 is when we saw that fairly heavy drop from like 380 to like 150, right? We've just been going from almost like a historical average to deeply above historical averages on the yield basis. So, and what that tells me is that the market is discounting a lot of things into this stock, right? There's a lot of risks, whether it be regulatory or competition, growth slowing. We know it's growth slowing, or regression in growth, regression in users. That's being priced into the stock, which is making the current yields extremely high compared to the risk-free rate when looked at a historical basis average. So that's kind of what I got. We'll see what Meta comes out with this week for earnings. I'm excited to see what they do. I personally kind of am leaning towards they're probably going to miss top line, and they'll probably meet or barely miss bottom line. So what I think is going to be happening is that they're going to be cutting back on a lot of R&D spend, just due to the macro environment, the economic environment right now, and Zuckerberg has even said this, that they have the ability to cut back on some of these expenses during this time to make sure that they maintain healthy bottom line income. So I believe they have a lot of levers to pull to really make sure that they stay healthy, and we'll see if that happens. They got a lot of work to do as far as keeping Facebook relevant. I think Instagram's a way better platform for right now, but they have a lot of work to do to keep Facebook relevant, and we'll see if they can capture that younger audience. If we go to the price right here, like 150, so let's see, I think the low was like 130. So even if we get to low 130, on the bearish case, we're still looking at about nearly 15% CAGR, compounded annual growth rate, over the next 5 years, assuming these assumptions. So, I mean, we'll see what happens. I'm excited to see what earnings are like, and after earnings come out and everything, I will probably go ahead and do an update video sometime in the next couple of weeks. I don't know. I want to get through other stocks and just keep on going through this type of routine and go from there. So hope you guys enjoyed it. If you did, leave me a like, go ahead and subscribe if you want to see more of these. I'm going to be keeping this format a lot because once I got it down, it's just easy to pump through them and hopefully provide some pretty valuable content. So hope you enjoy this. Have a great day, and we'll catch you later.